I'm sure you received that phone call, the one that opens with क्या आप stock market में trading करते हैं? If not in Hindi, then in your regional language. The moment you say yes, the pitch begins. Stock tips, index options calls, commodity trades, sure short setups, you name it. And you may think, what could go wrong with it? I wish it was that simple. Because in India, the business of giving trading calls is tightly regulated by SEBI. And even when the advice comes from a SEBI Registered Research Analyst, blindly copying it can still be risky, for reasons most people don't fully understand. In this episode, we'll break down the trading advisory landscape, what's legal, what's not, and even when it's legal, why following someone else's advice can still be a bad deal. We'll also look at how to evaluate advisors and the right way to use their research without completely outsourcing your thinking. I'm your host Sandeep Rao, and with that, let's get started. Like I always do, let's start by setting the context. The advisory landscape in India. Before 2013, stock market advisory in India was a bit of a Wild West. Anyone could dish out tips, shady operators, brokers, even business TV celebrities casually calling out buy and sell calls on air. If I have to think about it, there were no real barriers to entry. Accountability was limited and very little clarity on who was actually qualified to advise and who wasn't. It was pretty much each to their own. To be clear, it's not that there were no regulations at all, but most of them were broad, market-wide rules. Like the PIT, Prohibition of Insider Trading Regulations 1992, and FUTP, which is Fraudulent and Unfair Trade Practices Regulation, and Corporate Disclosure Norms, which basically aimed at preventing insider trading, manipulation, and other unfair practices. The period from 2013 to 2014 marked a shift from these general guardrails to a dedicated framework specifically for advice, the RA-RIA regime. Before we go further, a couple of terms you need to know, because SEBI doesn't use the term advisory as a catch-all term. In SEBI's language, you are either a research analyst RA or an investment advisor IA. SEBI, the Securities and Exchange Board of India, is the primary regulator for India's securities market. And within this advisory space, it defines two key roles. The first is RA or Research Analyst. An RA license is required for any individual or entity that publishes or provides buy, sell, hold recommendations on listed securities. Let me say that again. If anyone in India wants to give buy, sell, hold calls on any listed security, whether for free or for a fee, they are expected to be registered with SEBI as a research analyst. The second role is what is known as RIA or SEBI Registered Investment Advisor. An RIA license is required when the advice becomes personalized, which means the advisor must assess the client's profile, risk suitability before recommending anything. A simple way to differentiate the two. If someone does research on stocks or indices and gives general buy-sell recommendations without understanding your personal financial situation, that's research analyst territory. But if someone is doing personal consultation, understanding your income, goals, existing portfolio, and then advising on asset allocation like equity versus debt, position sizing, risk limits, and so on, that's investment advisor territory. You see, it's been a little over a decade since this RA-RIA framework came in, and SEBI has kept tightening and refining it, largely to protect investors from unlicensed advice and the kind of tip-selling ecosystem that thrived earlier. And do note one very important point here. Irrespective of whether someone is an RA or an RIA, SEBI does not allow them to directly handle your trading account under these licenses. In simple terms, an RA or an RIA cannot execute trades for you in your broker account. They can share research or advice within their license scope, but the act of placing the trade in your account has to be done by you. So now we have a clear sense of what the RA and RIA licenses are all about. Let's get to the next set of questions and understand what's legal and what's not. Point 1. No license, no advice. If someone is not registered with SEBI as an RA or an RIA, they cannot give buy, sell, hold recommendations. Period. That means unlicensed calls shared on social media or even inside closed WhatsApp, Telegram, or Discord groups is still illegal. Point 2. Even if they are registered, they can't publicly flaunt performance claims. This one is critical. SEBI does not allow RAs or RIAs to publicly market themselves using unverified performance numbers. So even a registered person or entity cannot go around claiming things like 80% win rate, 100% returns, only profitable trades, or my calls never fail, stuff like that. On a related note, as we speak, SEBI is working on a performance reporting framework, also called PAR-BVA, which is currently in design and should be out during the year 2026. Once it's out, RAs and RIAs who want to share their performance would have to get their performance verified by this entity before sharing it in public. While there is still some time before the PAR-BVA framework comes in, SEBI has also defined rules for sharing performance before the framework comes in. But either way, stay wary of any registered or unregistered entity that makes a public claim of extraordinary returns or performance. Point 3. Education versus advice. Now, one of the most important shifts in the last couple of years is that SEBI has made a clear distinction between investor education and investment advice. Earlier, a lot of people ran what was effectively advisory under the label of education. A course, a workshop, a YouTube channel, and then slipped in stock or option recommendations, that is, calls or model portfolios. That workaround is now almost impossible. Education cannot be a cover for buy, sell, hold recommendations. To reduce people using such workarounds to offer tips, SEBI's framework around education-only content also pushes educators to use lagged price data. That is, instead of current and live market prices, they need to use at least 3-month-old data. The purpose is precisely so that education doesn't become some sort of a real-time tip delivery system. And SEBI has been increasingly active in enforcement as well, including pulling up entities that flout these rules on platforms like YouTube, Telegram, etc. Also worth noting, these restrictions are only for securities listed in India. That's one reason you'll see many creators shifting to US stocks or crypto advisory where the SEBI framework doesn't apply. Point 4. Subscription fees and KYC requirements. Another investor-friendly change that SEBI has brought in is a cap on the fees and stringent client onboarding process. Talking about the fee cap, a SEBI Registered Research Analyst has an upper cap currently of around 1.51 lakhs per annum per family for individuals and HUF clients. Talking about the onboarding process, SEBI has mandated some documentation as well. Clients must sign standard terms and conditions, and KYC also needs to be done. Another important regulatory change is about maintaining a clean payment trail. Research fees must be paid into accounts linked to the registered entity so that it's clear who is charging and who is consuming the service. This matters because earlier, plenty of shady operations were running on Telegram groups and they would collect money via random UPI, QR codes, friends, relatives, shell accounts, deliberately avoiding any trail. I must say SEBI has done its best to shut that down. So the bottom line is, for offering research services, registration is mandatory. After that, fee limits exist, proper KYC is required, signing of TNCs is needed, and payment only to linked accounts are non-negotiables. Anyone flouting these is risking their registration. And for you as a consumer, this creates a safe, clean way to engage with research, at least from a regulatory standpoint. So with the legalities out of the way, let's move to the more nuanced part, the stuff that still can hurt people even when they are dealing with SEBI registered folks. For this video, I'll focus on research offered by SEBI Registered Research Analyst because that's the most relevant lens here. First things first, it's important to understand that just like individual traders, research analysts typically operate in one of the two broad styles of research: systematic or discretionary. If those terms are new, I have explained them in detail in this video. The link is in the show notes. Understanding this distinction is key because it affects how you manage capital and position size your trades. Now, moving to key issues to watch out for as a consumer or subscriber of research services. 1. Understanding the why behind a call. As a consumer of research, you should have a basic sense of how the analyst arrives at a recommendation. You don't need every detail, and they may not disclose full logic because parts of it can be proprietary. But you should at least understand the broad reasoning. Why a buy on this stock? Why a short on this index? What's the thesis? What's the trigger? What's the invalidation criteria? You need to know some of this at least. Completely outsourcing thinking is a pretty bad place to be. 2. Tracking, logging, slippage, and costs. One of the most common pain points is the gap between the recommended price and the price you actually get. An analyst might say buy at 200, but by the time you see the alert and place the order, the price might be 210, and that's slippage. On longer holding periods, slippage may not matter much, but in short-term trading, it can completely change outcomes. Then comes the bigger issue: tracking and transparency. Regulation requires research analysts to maintain proper reporting, but as a consumer, you should still evaluate whether the trade logs are clear, consistent, and actually usable. Ideally speaking, you should maintain your own trade logs and reconcile or match them against the RA's logs. And most importantly, always look at post-cost returns after brokerage charges and slippage. If something makes money only on paper but loses after cost, that's not what you would want, right? 3. Liquidity, circuits, and bans. This is a huge issue in low float stocks and thinly traded F&O instruments. With small caps, it's common to see circuits hit quickly. So it's very possible an RA recommends a stock and you can't even enter because it's already logged in circuit. If it's an occasional miss, fine. But if it's a pattern, then you should pause and ask what's really going on. Even in single stock futures and options, liquidity can be thin. If many subscribers place market orders around the same time, prices can spike sharply and then mean revert just as fast. Your fill can be way off the recommended price by the RA. And then there's the derivatives ban issue. Once a stock enters ban, execution becomes harder and liquidity worsens further. Net-net, in real life, you often cannot capture the returns shown in the recommended logs, especially in low liquidity instruments. So if you are subscribing to a service which is in the area of small caps or single stock futures and options, you need to be extra careful about the liquidity of these instruments. 4. Fees as a function of returns. The goal is to make money, obviously, but fees, that can destroy the equation. Let me give you an example. Let's say you have 10 lakhs of trading capital and RE delivers an impressive 20% return, that's 2 lakhs. But if subscription fee is 1 lakh a year, that's 10% of your capital or 50% of your profits gone in fees. And that's no way sustainable. A practical thumb rule for trading is to try and keep research fees within 5% of your trading capital per year. Lower is always better. If the fee itself forces you to take more risk just to recover costs, you are in big trouble. 5. Position sizing, capital allocation, risk, and the return math. This one is subtle but extremely important. Research analysts typically cannot and do not tell you how much capital to allocate, how to position size, or how to distribute money across multiple strategies. And especially in derivatives where leverage complicates everything, not knowing position sizing can be devastating. So even if the recommendation is correct, your outcome depends on your sizing, margin buffers, and drawdown tolerance. Let me give you an example. An option selling strategy might show you that it needs just 2 lakhs in margin. But that doesn't mean you should run it with 2 lakhs of capital. You will likely need a larger allocation, say 5 lakhs or more, to survive drawdowns and mark-to-market losses. So if the RA shows returns on 2 lakhs margins, but you had to allocate 5 lakhs in reality, then your true return percentage is going to be very different from what the RA shows. This is where many people get misled and worse, sometimes get stuck in a drawdown. 6, and the last point is about research and algo trading. The most interesting recent development is that SEBI has been working on a new algo trading framework, and it opens the door for research analysts to offer algorithmic trading strategies to clients in a compliant structure. As we speak, this framework is still evolving and the exact mechanics are work in progress. But over time, and perhaps very soon, this could reduce one major problem: the lag between signal generation and execution. That said, algo-based execution won't magically solve everything. Liquidity issues, position sizing, capital buffers, and cost realities would still affect the final outcomes. And these issues will remain just as important for research consumers and traders as they are today. If I had to think about it, I think algo offerings will benefit research analysts running systematic strategies the most. Personally, I'm very interested to see how this plays out. And that brings us to the end of this episode on the problems with trading advice and research offerings in India. We covered the SEBI framework for research analysts, RAs, and investment advisors, RIAs, what's legal, what's not, and the key things you should still evaluate even when the research comes from registered professionals. So the next time you consider subscribing to a service offering trading calls, strategies, or even algo products, you have a clear checklist. You know how to judge it, what to ignore, and how to use it without blindly outsourcing your decisions. That's pretty much for this topic. If you found this episode useful, do consider subscribing to the channel. It really helps us. I'll be back soon with the next one.